we had a brokerage that turned out to be a bad actor that stole $12 million from us.
12 million.
Yeah, I've seen a lot of frauds in different types of investments where the common denominator was, if I can save you a few million on the way to learning, that's my goal now.
Welcome back to the show, everybody. We got an incredible guest today. I'm really excited to have him on. I've got Justin Freishtat. Justin and I are going to be talking about how to protect the downside of being an LP. Now, just to give you a little background on Justin, he built a company called Heartland Foods and he ended up selling it to a private equity firm in 2022. So congratulations on the exit, by the way.
Thank you.
And now Justin is raising capital, manages investor relations at the capital advisor as the capital advisory for healthcare integrated technologies, managing partner of Kearns Capital, and Pitch Equity Fund. You're kind of busy the way it sounds.
Yeah, lots of roles in several places.
Yeah, you must have quite a team behind you to have all that going on. Now, on these funds that you're doing, what are they exactly? Are you guys going out raising money and being a GP?
Yeah, so depending on what the fund looks like and the scope of it, we've got all these different terminologies in the industry, right? If we're trading equities or any type of trading instrument, we call it a hedge fund. If it's a single piece of real estate, famously in multifamily, we call it a syndication. Or if it's a private equity fund, we call it that. But really, these are just different ways to set up a fund where you raise money and then deploy it into something as a conglomerate.
Okay, so you're out there as a GP. Are you investing too as an LP in any investments?
Yeah, that's how I got started in this world. While we were building Heartland Foods, I was taking profits and deploying it into different types of 506c investments, accredited only. So that's kind of how I got started, was deploying a lot of capital into different real estate syndications, some oil and gas deals, things like that.
Oh, oil and gas even?
Yeah, and going into something you don't understand is a good way of figuring out that you shouldn't be in the space.
You're not adverse to just a little risk, huh?
Yeah, I mean, it's we never fail, we just learn, right?
Right. Well, I think this is why this is so important, because a lot of newer investors aren't really sure how to worry about the downside, what could happen and how do I protect myself. So I think that's why this is so important. Before we dive into that, I want to ask you, what's it like out there raising money right now? Is the market good for it, or are you working pretty hard to do it, or what's that look like?
It's definitely the most challenging environment I've seen raising capital. With interest rates going up the way they did, there's a lot of deals, especially real estate investors, that have capital tied up where it can't be refied and you can't get the money out. So liquidity is definitely tight. But with that being said, what I've found is when you have a great deal, so for instance, on the friends and family raise we just did at Healthcare Integrated Technologies, we only needed to raise 6 million. We had 11 come in less than 3 weeks. So when you really have a great opportunity, the money's always there.
Right. Yeah. So now, when you're being an LP, did you ever run into a situation where there was a problem and you had to, you got stuck in a situation?
Yeah, several.
Well, let's talk about the worst one. Let's dig right in.
Yeah, I would say the worst thing that happened for me as an LP is, when you have an exit from a business, you want to mitigate taxes. And the easiest way to do that, at least what I thought at the time, which is still a great way to mitigate taxes, is to deploy your money into some of these real estate projects, commercial real estate that has a lot of CapEx and depreciation, and that can help you lower your taxable liability and also, make an investment. So when looking at all these different syndicators, I've worked with 5 of them as a limited partner. You're looking at spreading out risk. Number one, you don't want to be too concentrated with one operator. And then I didn't want to be too concentrated across any one asset class. So I'm going A, B, C, different parts of the country. That's how I looked at spreading risk. And I put the most capital with the firm that I believed was the least risky in terms of, a 20-year track record of syndicating apartment buildings, over $1 billion transacted. And what ended up happening is when rates went crazy, a lot of these deals didn't pencil anymore. the general partner had a tough decision to make. Do I tell my investors the truth? We might lose this deal. The GPs might have to put in more money. We might have to raise more from the LPs. Instead of doing that, what this guy did is he said, I can fix this. I'm going to move money from one project to another and float it, and then I'll just pay it back. Nobody will know. And this, my friends, is called wire fraud. So obviously the project did not get saved. He had to come clean, and we have a huge mess there. And the big lesson with that is that third-party reporting in place would have prevented something like that. Usually when you have fraud, you have these things, I think most of the time those people were generally good people with good intentions that ended up having to make a really tough choice and made the wrong one. And if you have third-party reporting in place, that just can't happen.
Yeah, that's tough. I'm sorry to hear you went through that. That was a story I heard fairly often when times went south, and good people, like you said, had to make decisions, and they were out of just complete despair. They were just trying to save everything, and because they're out there raising money from friends and family and other investors, and they start feeling guilty and like, okay, I can fix it by doing this. So that's a tough one. So now you spread your risk out over several syndicators. Not most people have that kind of capital to do it. So you want to vet the number one syndicator that you have out there, or GP you're going to be working with. How did you do? What was that process like for you? How did you pick that number one person that you invested the most with?
Yeah, for me, it was looking at, okay, how did you handle tough times? Everybody knows 08 was a total disaster, and this guy survived that, right? And managed through it and didn't lose his deals, was able to renegotiate with lenders. And so it's kind of, when things are going well, operating is one thing, but how do you behave when things go badly? So I always want to know in my due diligence, like, tell me about the tough times. Tell me how you navigated tough things. And if you don't have stories of tough times, I'm probably not going to invest with you, because it's counterintuitive. If you tell me that you've never lost, that you're a permanent winner, either I don't believe you, or you haven't gone deep enough in the game yet to experience loss. I don't know anyone more successful than me in investing that has not experienced massive losses, worse than mine. So that's actually something I look for. I want to hear about how you screwed up and lost some money.
And how you overcame it, right? Yeah. Recovered. Yeah, it's tough. Do you talk to, if you talking to a GP, you say, listen, I want to talk to some of your past LPs. I want that history. Do you go that far?
Yeah, I think talking to previous LPs are important. I did all those things with the syndicator that went bad. So just understand that no matter how much due diligence you do, there is always still risk in investing. But on the way into a deal, I want to know how much money the GPs are putting in. If they don't have skin in the game, that's another red flag, because when things do go bad or times get tough, like, are you going to put in the effort to see that project through? And if you don't have your own money on the line, it's easy to just say, it didn't work out, I'll send you a K1 for your losses.
Yeah. We had a situation with a bunch of multifamily we owned in Dallas. And this investor came in and he said, listen, I'd like to buy your portfolio. It's a small portfolio. It wasn't that much. And we said, well, it's really not for sale. And he goes, well, if you're going to sell, we were planning on developing the property is what we were planning on doing. And he goes, well, if you were planning on selling, what price would you look at? And we told him the number that, when we were going to exit, what we would be at after the development was done. He goes, okay, I'll take it. And I'm like, okay. And so he did. He paid cash, but it turned out, I find out later, he was the contractor, he was the GP, so he was getting fees from everybody before he was collecting fees from the contracting side, everything. I don't know what's going on with the property, but I think with the price he paid, and I saw some of the upgrades he was making that really didn't work in that area yet. That area was just starting to turn, and he was putting in stuff that was going to probably be needed in 5 years or so. But yeah, I'm sure they lost it. So I did a little research. If you looked at any of his projects, I don't know how this is in Dallas, Texas. It's a pretty small market actually at the time. I'm not sure how he kept raising money, because there was information there that this guy did this pretty regularly. And they're just taking some simple due diligence to go out to properties that they are talking to previous investors, looking at the properties. There are some horror stories there.
Yeah, I think for early investors, because I went through this too, you're new to the world. Private placements are pretty private. They're not easy to find in the beginning.
Yeah.
So you might listen to a podcast. That's how it started for me. And you hear some of these operators, you talk to them, and then you feel like that's your opportunity to get started, because you don't realize that there's millions of deals to choose from. There are tons of people doing this. It's just the accredited investor world is kind of quiet, and you're not really seeing a lot of advertisement like you do with public type investments. So I think that's the mindset thing is early on, is just understand, like, you should probably look at 100 deals before you pick one to even understand what that the I guess barometer of the marketplace is and what's available out there.
Yeah. Being smart, being an accredited investor, I think, is the key. But there's just so many workarounds for that anymore. They've figured out. So a lot of people that aren't accredited investors are actually out there investing. So that gets a little bit hairy as well. What are the most common mistakes that you see LPs making?
Yeah, that's a great question. I think probably underestimating the need for liquidity. So, saving up, I finally have, because most of these 506c funds, minimum's 100 grand. So, you're saving up 100K, you're ready to deploy into your first one, and you don't leave yourself enough cash. And then you rely on the targets and the projections, the cash flow, where the strategic refinance is supposed to happen. You go in believing these are hard timelines when they're really just targets. It's market dependent. So I think the first mistake I see LPs make is just deploying capital too early. You really should, when it goes, just understand it might be gone for 10 years before you see anything. So if you have an attachment to that money, or there might be a need for it in your life in the short term, you probably shouldn't deploy it.
Right. I think people need to understand that there's two things you need to be doing here. You need to be doing due diligence on the GP and the property as well, to understand that market and what's really going on. Before you guys go in as an LP, how do you break down the investments?
Yeah, as an LP, I'm looking at this point, it's a little different, but I'm looking at how much market research did they do, right?
Yeah.
If you're just sending me a deck that has all the information on the deal itself, that's not enough. I want to see how much research you've done about the demographics of the area. What else is in the development pipeline? What types of job stability is in the area? What industries are there? Is it a town that's dependent on one company that could move, or all these other risk factors that become kind of black swan events in deals that you don't see coming. So you got to look at the bigger macro picture outside of just that piece of property you're buying. Yeah,
there was an investor that we were talking to, and fortunately he did his due diligence before he invested, because he was getting ready to go into with a pretty good sized GP that had a good amount of multifamily properties, but their focus is around military bases, and they've had some pretty decent success. But he had a new investment come up, and he was getting ready to look into it. So he started doing some due diligence. Well, that base was getting ready to close, and the GP didn't even know that. And so nobody's perfect, right? The GP he felt terrible. He goes, I made a mistake there.
Yeah. And don't fall in love with one deal. I think if you've got, let's say, 500K to put to work, spread that across 4 or 5 deals, even if you love one, because I will tell you, some of the ones that I thought were going to be home runs weren't. And some of the ones I was like, ended up being the best ones. So you just, to a certain degree, I guess that's why it's called investing. Things are going to change. The environment's going to change. And, you humble yourself through the experience of knowing that you actually don't know much.
That's funny, because when we did I've got a business partner, George Pino. He's the CEO of our commercial brokerage company here in LA. And our first property that we ever bought, a little 10 unit in Adams District here in LA, it was a home run. it was just that we bought it at like 275, sold it like 6 years later for $1.3 million or something like that. The second one, a 3-story walk up in Koreatown. I think we were riding high because we saw what was going on there in Adams District. I think we were believing our own stuff, right? Well, we got out of that second one barely. But you don't do a 3-story walk up, because carrying grocery in a Hispanic community, carrying groceries up that third flight is a killer. And keeping those top 2 rented out was a real lesson and very humbling. So, it's sometimes you don't want to believe it. And you're right. You want to make your investments. You see a lot of new people that want to get into investing, and they just want to they want to get investing. So they take the first deal. And you're right on point. There's deals out there all the time. Be patient, keep looking, and find the right one. Now, you'd mentioned something earlier on, Justin, about third-party reporting. Could you kind of walk us through that and how that works?
Yeah. So I've seen a lot of frauds in different types of investments where the common denominator was too much freedom for the general partner. And what third-party reporting is saying, instead of the statements coming from the GPs, instead of money moving from bank accounts to wherever it needs to go by the GPs, you put a third-party administrator in place that facilitates transactions, that's auditing the fund, sending the reports to your limited partners. So that way it puts a checks and balances in place. So for instance, in all of our funds, we have third-party reporting in place. If I wanted to, as a GP, steal all your money, I would go to the fund banker, try to move the money, and they would say, well, we need third-party admin to sign off on this. So you have 3 people that have to agree and sign off on any money movement.
Right.
So that right there would prevent a lot of fraud.
Those are typically on bigger deals, I'm guessing, right?
It could be small, it could be big, it could be a hedge fund, it could be a syndication. And I think something for operators to think about is using some of these third-party done-for-you portal models like Veravend or Avestor, where they handle everything: the accounting, the reporting, your PPMs, your deal disclosures, compliance. It can all be outsourced. And then you get a nice, beautiful portal where your investors can log in and everything's organized, and they can click and invest and do everything within one place. So that's how we've launched our new private equity fund and real estate fund, is with Avestor.
Okay. How long has that been around? Is that fairly new?
I think it is fairly new, because the first funds we launched, we had to piece it together. So we had fund legal here, you get our fund accountants over here, and then we hired a third-party administrator to do the accredited investor checks on the way in, the KYC, the know your customer protocol, identity verifications. Like, all of this compliance stuff is really important if something goes bad, because subscription agreements, lawsuits, indemnification. Like, I've been through that, and it's you will sleep a lot easier if you have a company that specializes in compliance and reporting handle that for you.
Yeah, absolutely. Is it expensive?
No, it's really not. I think you're paying, depending on your fund size and everything, a couple grand a month to have all that done.
Wow, that'd be worth it. Recourse. Let's say I'm an LP and everything starts going south. What does my recourse look like?
It really depends on the subscription agreements and what's in the documents. Going through litigation on both sides of being sued and having to sue people and entities, it always comes down to the docs. It's what's in there. So that's a great point on the way in, is have an attorney that specializes in this, read everything. Just because you can read it doesn't mean you understand what it means in the eyes of the law. So if you're an LP, have your subscription documents read by an attorney. And if you're a GP, make sure you've got a great attorney that drafts them for you.
Yeah, I agree. We talked to so many. I've done a few syndication, quite a few syndications actually, and we've had success on our syndications. We're very fortunate. But talking to our investors later, I said they didn't even read the documents; they just signed it. And I'm like, thank you for trusting me that much, but what if something would have happened? You need to make sure you're looking at those documents and going through them with a fine tooth comb, and get an attorney involved. Don't just take this lightly, because things happen and you can end up in a tough situation. How many in your lawsuit did you have some good outcome in your lawsuits?
Yeah. We're so in one of our funds, we had a brokerage that turned out to be a bad actor that stole $12 million from us.
12 million.
Yeah, 12.7 million stolen, or
That is
missing,
a tough day.
or in transit, whatever you want to call it. We don't have it. So,
yeah, exactly.
So my first time going through something like that on the GP side of the fund, you don't know what to do. So you call fund counsel, you get on the phone, you're like, all right, what do we do? And you assemble a whole legal team, and you go after them, right? So we sued 6 entities and individuals that were involved, either executives or the company itself. Turned out to be a worldwide fraud. I mean, we're talking billions of dollars. But 20 months later, we went 6 for 6. We either settled or have judgments against every single entity and individual, and now we have a collection team in place that's recovering assets. So at brutal grind, 60 plus investors, that took that ride with us. And I can tell you there's been no worse experience feeling. It's definitely taken years off my life when people trust you with your money and something bad happens. But, we couldn't have fought any harder, and we've got a great outcome now. So in a way, it's like when we get these people their money back, I think they'll be soldiers for life.
Yeah, no, I would say so. I just want everybody to hear that, here you are, a very experienced investor, and it happens. Look what you done, 20 months. Actually, I thought it'd be a lot longer than that. I thought you were going to say like 4 or 5 years, but that's why it's so important that you read this documentation, you take a look at it, ask questions, get a good attorney to take a look at it, because things do happen. Justin, what's next for you? You're out there raising money like a madman, I guess, right?
Yeah, we're going to new levels with these deals. Right now, we're raising for a massive project in Chattanooga. It's called The Bend. It's 120 acres of development. It's like a whole city on the water. So it's going to be multifamily. There's Toll Brothers is coming in for subdivision, a downtown, movie theaters, restaurants, and we're buying a big piece of that project. It's a total of about $4 billion of development. So
wow.
I'm excited to be playing in a bigger league with my partner, Scott Boroff. He's got 22 exits. He's rang the bell on Wall Street, and he's got over $1 billion raised on Wall Street before going into the founder role. So I'm just excited to be working with him.
Chattanooga is really growing right now, isn't it?
Yeah, that's what he says. I mean, he's a Tennessee guy. It's not my market, but so we're doing that project, and we're doing another one smaller, which is just going to be single family homes on the water in Knoxville. So,
okay. Yeah. Again, an area that's growing, so, well, that's fun. Well, how do people get in touch with you?
I'd say probably social media. I'm everywhere. Yep. And there's nobody else with my name in the world. I'm easy to find. It's tough to spell, but Instagram, LinkedIn, Facebook, wherever your favorite place is, shoot me a message. I answer them all.
Okay, thank you very much. Well, Justin, I appreciate you giving us this insight, because I think there's a lot of people out there want to be investors. They just don't see the downside of it or understand it. And I think this was key information for them. So thank you for today.
Yeah, absolutely. For me, it's, if I can save you a few million on the way to learning, that's my goal now. And that's the biggest part of my capital raising process, is actually just educating people on how to protect themselves, whether they invest with me or somebody else. I just want to, make this investment world a better place.
Agree. Thank you very much. And for those of you watching, if you could, please give us a like. If you haven't done so, make sure you subscribe.